Well, good afternoon and happy Thursday. Today is Thursday, August 12th, 2021, and we are delighted to be hosting LPL Chief Market Strategist and Senior Vice President, Ryan Detrick, for our 2021 Mid-Year Market Outlook. My name is Ward Keever. I am the President and CEO of Covenant Wealth Strategies, and I'm joined this afternoon by one of our leadership team members, Michelle Fisher. We will be answering questions at the end of today's presentation, but you can send your questions in anytime by emailing Michelle, that's with two L's, Michelle at covenantwealthstrategies.com. I will gather the questions and engage with Ryan after his formal remarks have concluded. So Ryan, I understand that we had this event scheduled actually in July. It might have been around July 28th, but that we had to postpone this event by a few weeks due to the fact that you qualified for a special cheerleading event. Do I have that exactly correct?
Not exactly, Ward, but it's close, right? It's close enough for government work. My daughter, who's going into the 8th grade, she had her very first like team competition, the 8th grade middle school competition. So I've never been to a cheerleading thing quite like that. It was interesting. It was like you spend all day there and they do their thing for 6 minutes. You know, it's like I've always heard about swimming parents. You wait all day and the kid swims for a couple minutes. It felt like that, but it was a fun experience. They got second out of, 15 teams, give or take. So sorry for having to push this back a month. I guarantee you we'll have fun today, but it was a neat experience last month seeing her do her cheer with her team.
Well, I'm glad to learn that it was your daughter who was cheerleading. I was concerned that you had maybe a little moonlighting job on the side where you were doing cheerleading, and so I appreciate that clarification. I should also point out that if your daughter needs any cheerleading tips, our very own Miss Michelle Fisher was a champion cheerleader in her own day back in 8th grade and high school. So if your daughter needs any tips or anything, just have her reach out. So I also understand that our call today actually almost didn't happen because there was some concern about whether or not you were going to make it back from a recent ziplining adventure. So I think we'd all like to hear a little bit more about that.
Yeah, I made it, which is good. Yeah, Ward, so I'm down in Charlotte and, it's really hot down here. So we'll go, what we say, up in the mountains. Like you've maybe heard of Appalachian State, App State. That's up in Boone, North Carolina, Blowing Rock, North Carolina. It's up in the mountains, beautiful area. And the family and I, we like to go up there a couple times a year, actually in the winter and summer. Summer, it's a lot cooler. It's like 20 degrees cooler there than it is here. So that's awesome. But it's up in the mountains, so there's lots to do. I said, let's do some zip lining. So I looked in, found a really cool zip lining place. It's like 11 different zip lines. And once you get the hang of it, it's not too bad. You're not going anywhere. It's scary that first time you jump and you go a quarter mile down the road, zipping along at 35 miles an hour. But, wife, 3 kids, myself, and a friend, my daughter's friend went too. And we had a blast. It was really fun. And zip lining's like, actually looking back, I shouldn't have been nearly as worried about getting hurt. It was the hiking. We hiked up some mountains, those trails. You can slip, hit a rock, you can actually twist an ankle. A lot easier to get hurt hiking than it is zip lining, I learned. But the good news, I survived everything. And I made it. So it was a blast.
Well, I've just always found it interesting that they give you those helmets for zip lining because I'm thinking, if there's a problem, that's probably not going to fix it. So anyway, we're glad that you made it back safely. And without further ado, it's my pleasure to reintroduce to our audience one of our all-time favorite speakers, Mr. Ryan Detrick.
All righty. Well, thank you, Ward, and thank you, Michelle. Thank you to everyone out there. You guys keep inviting me, so I will keep on coming back as this is fun. We've got a lot to discuss. There's just so much going on out there. So, we titled this the Mid-Year Outlook. There's a lot. It's funny. Funny might not be the right word. We wrote our mid-year outlook, I guess, right before July 4th. So just whatever, almost 2 months ago, give or take. And just a lot's changed. I mean, the bull market's still intact. Literally, as we speak, guys, the S&P 500 closed, I think it was its 47th all-time high. Dow made an all-time high. Just think about this. The Dow started trading May 26, 1896. Charlie Dow created the Dow Jones Industrial Average. That's over 120 something years, right? close an all-time high today. I mean, that's pretty cool when you think of it like that. But there's a lot more we're going to talk about. We're going to talk about stocks and bonds. We're going to talk about the economy, and we're going to talk about policy. And tell a few jokes along the way and have a little bit of fun as well. But I've been with LPL for, crazy to think, 5.5 years now. 5.5 years, a chief market strategist. My role, a 29-person research team. We manage more than $60 billion worth of assets. I draw what I say the snowman, like the big picture view. We like stocks over bonds. We like large caps over small caps, whatever that might be. And then I work with really smart portfolio managers, analysts, other people. I'm the guy that gets to go on TV. I'm on TV quite often, radio. I've got a face for radio. They keep bringing me on TV though, but it's a lot of fun to work with our advisors and help clients explain to the best of our ability, explain what's going on out there. And that's exactly what we're going to do. Like we said, Michelle, with 2 L's there's the email you can use again to send some questions. And again, we're just write them down and remember them. We're definitely going to leave 10 minutes or so here at the end, or I'll stay as long as you guys want me to. And we'll do some questions at the end. But let's just put things in perspective. The S&P 500 is a little bit going on here, but the S&P 500 has almost doubled from the lows of March 2020. I know we all remember March 2020, most volatile stock market, most volatile month in the history of the stock market. Oh, by the way, guys, today is Thursday, the 12th. That makes tomorrow, Friday, the 13th. You might think, that's got to be bad, Friday the 13th, Actually, no, I was just looking at some numbers. The last 2 times, and believe me, this is totally random. It's just kind of fun. The last 2 times we had a Friday the 13th, March of 2020, stocks gained 9%. Just think of how volatile that time period was. And then last November 2020, had a Friday the 13th, stocks gained over 1%. And historically speaking, Fridays are usually one of the better days of the week. So don't get too worried. Friday the 13th, a little scary, but not for our stock market. But still, turning back to this slide now. The current bull market is up almost 100%, up like as of today, like 99% off those lows. Let's just put it in perspective. We know it's been an amazing run, right? We're going to talk about some of those things. If you've kind of followed along with what I've said before, what LPL Research has said before, we've been bullish, right? We've been optimistic, and fortunately, we've been on the right side of this trend. LPL Research was the only broker dealer or financial institution, and I know this because I look it up, that upgraded our view on equities the last week of March 2020. Now that was you upgraded your view, stocks were down a lot. Of course you did. Trust me, it was petrifying to do that. There's a lot of fear, right? And again, but we use a process, and there's a lot of the 5.5 years I've been here. That's the thing I'm the most proud of. That's kind of my call at the end of the day, because it wasn't an easy call because there's so much uncertainty and so much fear. One of the easiest ways to put it, why we did it, we said, listen, if the asteroid's going to miss again, down 34% in 6 weeks, fastest bear market ever, fastest 30% correction ever. If we get any good news at all, we could have a big rally. Well, guys, we've up 99% from those lows just the last 12 months, right? Last 12 months, we're up like 35% on the S&P 500. So there's been a lot of good things, but still put it in perspective. Back on this chart here, you can see it usually takes years for a bull market to officially double, go up 100% off the lows. So we're still bullish, yes. But we've been awfully spoiled, it might be the right word to use, with some of the incredible returns that we've seen. So just kind of put things in context that the upward trend is still in play. But hey, maybe we could have a pullback or consolidation, be a great time to continue to kind of get your portfolios in a good order, and maybe buy things a little bit cheaper for what's going to be continuation of a bull market, as I'm going to explain. But just really interesting. The previous fastest bull market doubled in 2 years, as you can see there. That was the last one we had, 2009, 2010, start of that bull market. So just really a fascinating chart, I think, that shows how quickly things double. Now, 2020, let me just minimize one thing. There we go. We're good now. All right. 2020 was bad. 2021 was something all by itself. So we came into this year thinking, listen, stocks might gain about 10%. Earnings probably gain about 20-25%. Economy should continue to grow. Maybe one of its best years we've seen in a long time. Guys, all of that's happened, right? I mean, the stocks are up like 18-19% for the year. We might see the best year of economic growth since the early 80s, maybe since 1954, if things get a little bit better. Truly amazing. But 2021 didn't start off that great. You guys remember at the Super Bowl? Think back to the Super Bowl. People literally had underwear on their faces. I'm not sure. I was like, oh my God, after 2020, as crazy as it was, now I got people wearing underwear on their heads at halftime. That was the weekend. So maybe I'm getting old. I'm like, who is this guy? Anyway, so that's kind of Fun one. Also, how crazy has 2021 been so far? This is a real headline. Artist sells invisible, keyword being invisible, sculpture for $18,000. Here's my sculpture. Someone paid $18,000. That's kind of unique. I mean, we've seen some real unique things this year. That might be the craziest thing. But the good news is we've made it, right? I mean, I'm so honored to be here again, talking with all of you. Clearly COVID's not over. I want to make that very clear. The Delta variant, things are happening, but we are hopefully on the other side of things, and we've made it. And I love this picture, Marty and Doc from Back to the Future. They got together recently, and it's just a nice way to, you can hug somebody again and maybe not wear a mask necessarily to do it. So, we've made it to the other side, and it's really, really exciting. Now, one final thing, we're going to get into this. One real world worry. By the way, I'm home, if you can't tell. That's my an NBA Jam. Maybe if you remember that old game. I bought that during COVID. So I am in Fort Mill, South Carolina. We've got a big office, LPL does, just up the road. So I'm usually in the office, but not this week. But anyway, so one real world worry of like going back to the office, right? I mean, we're going to start going back to the office eventually here. I think it's going to be our definition of kind of what's office attire. I'm worried that, returning to the office after working from home over a year, we all might go to the office and think that's proper attire. Anyway, so let's get it. And I am wearing shorts right now, by the way. I mean, full disclosure, I think most of us wear shorts, when we do this. It's kind of funny. So chief market strategist, 5.5 years of LPL. It's an honor to get to do what I do. I don't take it lightly. I like to have fun a little bit, but we're stewards of assets. At the end of the day, I'm one of the few people you'll see on CNBC or Bloomberg or Fox, wherever you get your news. I do all of them. That when I talk, what I'm talking about, I'm not just pontificating. What I'm talking about is what our almost 30-person research team thinks. And if I say something that doesn't work so well, believe me, there's complications to that, because that's how we're positioned our portfolios. So, I'm on the same side of the table, I think, unlike a lot of the other talking heads that go on TV. So that's just something that is, again, something we don't take lightly. And it's just been very rewarding. If you followed LPL a little bit over the last year and a half, we've been very bullish, thinking this is going to go higher. This is going to go higher. A year ago, we had what we call LPL Focus, just one of our big events. Bert White and myself, he's our chief investment officer. We sat around a campfire dressed as Boy Scouts, kind of funny. But we talked about, Bert said, Ryan, what's one of the biggest worries you have? This was 12 months ago. All right, off the lows, everyone was still pretty bearish. I said, Bert, my biggest worry is, what if things get better? What if we get a vaccine sooner? What if we have more fiscal and monetary stimulus? People aren't positioning their portfolios. That could be the biggest worry, is this bull market that has started can continue. We're up 35% off of that level a year ago when Bert and I talked about it. And that's kind of the way I'm really, really happy and proud, I guess, of the way that our research department has kind of stepped up and done things. Lou Holtz. Lou Holtz says, you look at life, 90% of life is how you respond to something. 10% of life is what happens to you. LPL Research, we did not predict 2020. I'll be very clear there. Obviously, what happened, though, with the terrible pandemic and recession, but how we responded to it by upgrading our view on equities, by being very open and honest, doing webinars and doing podcasts and blogs. And we were very out there, and really proud of that. So let's go down memory lane. Remember this guy? This is little Hercules. He was big about, well, he's still big. He was very big in the news about 20 years ago. He's 12 years old there. Now, the interesting thing about little Hercules today, if you talk to him, he's not built like that anymore. He says doing that to his body at such a young age really impacted his joints and honestly the way he grew, right? And he really he's like low 30s right now. And he has extreme health issues for someone that way because he did too much too fast. So just think about that. Too much too fast. This is Robert Wadlow, the tallest human being to ever walk the face of the earth, at least that we know of, over 9 foot tall, had pituitary gland issues, obviously. You can see him next to some average 6 foot tall adults, just truly amazing. Looks like a superhuman hero there. Tragically passed away at 23 years old. All right. He literally, his leg started breaking. It's a terrible, terrible death. He got a terrible infection and passed away. Last year and a half of his life, he couldn't even walk. He had to use the world's tallest, canes and huge wheelchair but really just was almost bedridden. So again, too much too fast. Those beautiful redwoods that grow out in Oregon, if you got mommy and daddy trees all around them, they grow a little bit slower. But if you don't have mommy daddy tree, because they take all the sunlight, if you don't have mommy daddy trees and they soak up all that beautiful sunlight, they grow super fast. Take a guess what happens 15, 20 years later. Those trees are supposed to live a lot longer than that. Those are more likely to have infections because they didn't get the root system they're supposed to have, and they can actually die. So again, growing too far, too fast can be an issue. Which brings, what's this guy talking about? Which brings us to this, the stock market. Guys, there's something called, I keep this pretty simple, hopefully, a secular bull market and a secular bear market. A secular bull market is when stocks go up for like a decade or more. And a secular bear market is when they go sideways potentially for a very long period of time. So let's take a look at the screen here. We have the first secular bull on the left there, 1950 to 1968. Stocks went up for the most part for 18 years in a row. Now you've all heard of the 7-year itch, scientifically proven. How we view relationships, jobs, cars, whatever it is. 7 years in, sometimes we just get bored of it and want to change. It's just how our brains are wired. Stock market's kind of like that. 1957, that's that circled area there. 1957 had a bear market and a recession. 7-year itch took place. Then you had the 1970s. You had an 18-year bull market. Then you had the 1970s. Terrible time to be invested. Stocks did horribly. I know a lot of you probably remember the high inflation, relatively weak growth that we saw. Stagflation is what we called it. Stocks did nothing for a decade. Horrible period. Then the 80s came along, and all of a sudden, the S&P makes new highs. 1980 kicked off the 80s, 90s bull market. From 1980 to 2000, stocks did amazing. Add 7 to 1980, and what do you get? 87, 34% correction ever. Was the fastest bear market and 30% correction ever, other than the recent one we just broke it with. But then after that, you had another 13 years of stock gains. They say history doesn't repeat itself, but it often rhymes. So said Mark Twain. After the 7-year itch, we saw continued strength. Then go back to the 2000s, a secular bear market. We all invested through that or lived through it at least on this call, I'm assuming. From 2000 to 2013, you know what the S&P did? Nothing. Absolutely nothing. Two 50% haircuts in the middle. The 2000s were worse for stocks than the 30s. Think about that. And then for whatever reason, after 13 years of doing nothing, stocks broke out in 2013. I think it was March or April of 2013, kicking off a new secular bull market. Add 7 to 2013, and what do you get? Again, we talked about this at LPL Research. We didn't quite see the pandemic and what happened in 2020, but the 7-year itch took place. And then what happens next? Who knows? But history would say we could have years and years of a secular bull market. So there's going to be scary headlines. You're going to want to call Ward. You're going to call your advisor. You're going to be worried. What's going on exactly? The headlines are out there. I work with the media all the time. Their job is to get you to click on things sometimes. But the truth is we're going to have pullbacks. We're going to have corrections. Guys, we haven't had a 5% correction on the S&P since last October. We're pretty spoiled. That's why I started the slide about how we're up almost 100% already, off those lows. We're pretty spoiled. It doesn't mean the bull market's over. I'm going to make that very clear here. But, we could see some choppiness and some frustrations. Just be aware that's kind of how things work. And you think about Lawrence of Arabia, a pretty cool movie. If you remember the movie Lawrence of Arabia, there's a candle, and the one guy takes his fingers and pinches out the candle. The other guy looks at him and goes, I want to try that. He goes up to the candle, pinches out, screams in pain. He's like, how in the world did you do that? The first guy who pinched it didn't react, said, you just got to know it's going to hurt. Guys, that's investing. I mean, the truth is everyone loves bull markets. Everyone loves making new highs. It's going to hurt a lot of the time, and going into things knowing it's going to hurt when things are bad, that can kind of help your mindset. They always say the stock market's the only place where things go on sale, yet everybody runs out of the store screaming. That's the truth. I mean, 2013, we upgraded our view in equities. I'm the guy that made the call. I think I was under my desk hiding and reached up and hit send on that email because I knew I was going to get some really crazy looks, and we did, because things were that scary, obviously, in March of 2020 when we did that. And it's really unique, just kind of the way our brains are wired, though, and it's just kind of how we are. So let's get in. So Regis, I love this quote by Regis. We used it a lot. I'm involved in the stock market, which is fun and sometimes very painful. That is probably the best stock market quote I've ever seen, and I've seen a lot of them. So I really like that one by Regis. And one more, and then we're going to get into our forecast. I just like laying the groundwork here from a bigger perspective point of view. Secular bull market alive and well. We've been spoiled. That's kind of two highlights of what I've said so far. So, we might have a pullback someday, probably will, and use this opportunity. Don't get too worried. There's still a lot of positives out there we're going to talk about. But the longer you're willing to hold something, guys, time is on your side. All right. And this is an easy way to show it. Every one day, the stock market's up 52%. That's on the left. Check out on the right. You're going to hold it for 10 years. You're up, 5 out of 6 times, 87%. You're going to hold it for 25 years. The stock market's never been lower. All right. This is amazing, right? So in March of 2020, when the stock market was down 34%, I could have shown you these numbers and said, listen, things actually go astronomically higher because we're selling off. But a lot of people didn't listen to it. A lot of people were worried, and myself included. I had very big concerns too. But we followed a process at LPL. Bert White said this. He's like, the time to get ready for the storm is not in the eye of the storm. It's before the storm is there. You want to hunker down in the eye of the storm. So kind of get ready for the next time we have some market volatility. Use it to your advantage, and know that with time, you're likely going to have higher prices and higher returns, or what I should say. I look to the future because that's where I'm going to spend the rest of my life. Another great quote there, George Burns. Let's look to the future, guys. The mid-year outlook 2021, titled Picking Up Speed. Now, if you remember our previous outlook, this is the mid-year, the one at the start of the year, we called it Powering Forward. So there's no other way to go. We've got to power forward. That is exactly what our economy is doing, the spirit of America, the spirit of the world's been doing, and fortunately, stock market has been powering forward. Now, bonds haven't done quite as well. We'll talk about bonds here, but for a well-diversified portfolio with stocks doing what they're doing, most people are probably in a pretty good mood as we sit here today. But picking up speed. Even since we started talking about this and building out like in April. I mean, that's when we have to write something like this and come up with the ideas. We've picked up speed. Have we ever? Again, 47th new all-time high just today on the S&P 500, which is for the year, at least for the year, which is one of the most new all-time highs of any year in history. We've still got a long way to go. Just so you know, fun little talking point. Hang out with your friends this weekend. Most all-time highs ever in any one year, 77. All right, 1995 had 77 new all-time highs. With the 47 this year, if you extrapolate that out, I think it comes out to like 40, or I'm sorry, like 40, or I keep saying 40, 74 or 75 new highs extrapolated out. So we don't anticipate breaking that record, to be honest, the rest of this year. But just be aware that this is a really incredible stock market so far. So picking up speed, I kind of already talked about that. The economy. Let's talk about the economy for a second. Well, actually, you know what? No. Well, just a little more groundwork. The idea of picking up speed is wonderful. It gets you where you want to go faster. Who doesn't want to get places faster for the most part? But at the same time, think about speed. It can work the other way, right? You're going too fast. You hit a speed bump, hit some water. That could be a problem, right? Remember the Tour de France a couple months ago? That woman who had the sign a little too far out and she nicked the one bike. What happened after that? That one bike caused an enormous, well, the bike didn't cause it, she caused it, but that one guy who spun out caused an enormous accident because speed can work both ways. So we're happy with speed. We're optimistic that it can continue, but just be aware with this much speed, with all the policy that's out there and different things, sometimes speed might be a little bit of an issue. Not our base case, just be aware of that. So the economy speeding ahead. We're looking at economic growth this year of about 6.5% GDP. As you see on the right there where it says United States, a lot of numbers here. Just know that is one of the best years we've ever seen in the United States. Last year, we lost 3.5% GDP. Just so people know, GDP is gross domestic product. That's simply your economy, right? How much your economy, all the goods and services people buy, how much your economy is growing. You want GDP to be going higher, and that means your economy is growing. Well, it went negative last year, not a shock, but this year it's come back and then some. Just recently, like the last GDP report, like 2 weeks ago, GDP now is above where it was pre-pandemic levels. So the economy is actually higher now. Now, remember, the stock market was making new highs like, this time a year ago almost. So the stock market kind of leads the economy. One of the big takeaways that we learned last year when the stock market this time a year ago was making new highs, everybody's looking around like, How's this possible? Everybody's unemployed and the data is terrible and people are tragically dying. It's horrible. Yet the stock market is a very cold, stock market has no heart. Stock market doesn't care about our feelings. It was sniffing out the fact that, there's more policy coming, fiscal, monetary, and honestly, vaccines and all these good things that are taking place. And that's why the stock market was leading us last year and continues to lead us, honestly. So again, that's what's going on around the globe, emerging markets. They're seeing a little bit of weakness so far this year. I think the next slide. Yeah, there it is. Let's go to this one first. This is kind of the global growth expectations where we were at the start of the year to now. The incredible thing, you look at US, right? The orange was at the start of the year. Our GDP forecast is now up close to 7%. It was like 4% start of the year. You look at places like, Eurozone and Japan, some disappointing growth. Honestly, some of the growth out of China, it's still improving, but it's been a little on the disappointing side as well. So we think, it's just really, really impressive, the growth we've seen out of the United States relative to the rest of the world. Although Eurozone and Japan, we're not bearish on those, even though they haven't seen much economic growth, because we think it's a 2022 story. We know the playbook: get more shots at people's arms, things will open up. They're having a little trouble doing that, but they're going to get there. So we're optimistic maybe in 2022, Eurozone and Japan can do a little bit better, but we think the US is having some incredible growth. So one of the other big concepts I want to make sure you're aware of is we are officially out of the recession. This economic expansion is just over 1 year old. The government calls that, and they called it maybe about a month ago. We all knew the recession was over, but now it's official. So what I'm showing here, you see what says 5.3, that orange line that goes across? That's the average expansion. All right, the average expansion in our economy lasts about 5 years. Check out the last couple. They all lasted well over 5 years. I mean, the last one was almost 11, right? And it took a 100-year pandemic to knock us off, or we'd probably honestly still be growing here. So the truth is, these expansions, once they get going, it's kind of like a cruise ship, right? They keep going. It takes a while to stop. We stopped on a dime last time because of the pandemic, but once your economy gets going, it can go for a while. And we're optimistic that, hey, we might be average. Like, hey, let's be average. We can still have another 4 years of economic growth. And the key concept there from an investments point of view is this: when you have economic growth, you tend to have higher stock prices because you tend to have higher earnings. It's kind of that simple. It's during recessions when trouble can come. Now, it's not that perfect. 2011 stocks are flat. 2015 stocks are flat. 2018 stocks were down. But for that 10-year period of growth, the S&P gained like 401%. All right, so it wasn't straight up, but it was for the most part. And we think there's a tailwind going on here with the economy growing that likely has years to go. Now, I will say this much. I love this joke, and you can use it next time because it's a good one. The idea of average, there's a statistician. He put his head in a bucket of ice and his feet in the oven. I said, hey, how do you feel? He goes, well, on average, I feel pretty good. So anyway, no such thing as average, but still, there's hopefully one of the concepts I want you to take away from today. This economic cycle of growth can have a long time to go. Let's see here. Let's talk about inflation, because I know the question is going to come up, and we can still talk about it later. But go to the store. I paid $6 for a gallon of milk a couple of weeks ago. Yeah, it's one of the healthier milks, whatever. $6. I'm like, oh my goodness. Things are pricier. Go fill your car up, right? I mean, inflation is happening. Now the camp is, though, whose camp are you in, right? Well, no, before I go there, let's talk about the slide. So on the left, that's a recent Barron's cover, the I word, inflation. Just so people know, inflation is like when prices of goods go higher, right? And usually when you're coming out of a recession and an expansion, you have some bottlenecks in supply chain and material issues, getting materials made, and you can have higher prices. I've got a hot tub just right out that window over there. All right, my hot tub has a leak in the cover. All right. They told me it'd take 22 weeks to get a hot tub cover because the materials for the hot tub, they just don't have it. Because everything shut down a year ago, and then we just opened up just like that, and everybody's buying hot tubs and hot tub covers. That's just one example, I'm aware. But trust me, they said my cover is like $400 or $480, something like that. If someone said they had the cover for $600 and I could get it tomorrow, yeah, I'd be paying more. That's kind of the real world example of kind of what's taking place as we open up faster, kind of like we talked about, faster than anybody expected. But on the left, the I word, that's Barron's. Check out 2 years ago. 2 years ago, I like to think he's sleeping, but I think that dinosaur is dead. It says, is inflation dead? All right, that was 2 years ago. So just be aware, the market is a funny way. Once everyone's talking about it, once all the newspapers and magazines have talked about it, you think the stock market knows about it? The stock market's probably pricing in higher inflation. There's no doubt about it. We're going to see higher inflation going forward. But is the stock market truly going to be caught off guard? We don't think so, right? And that doesn't mean we don't go to the store or fill up our tank and pay more money. I'm not minimizing that. We're probably going to be doing that for a little bit here. But to think the stock market will be caught off guard, I think that's just naive. Now, whose team you on? There's Team Transitory. That's the team LPL's on. And there's Team Trouble. So on the left, you've got new, or I guess say new, yeah, still say new President Biden there, and Jerome Powell in charge of the Fed. We'll talk about the Fed in a minute. Transitory simply means prices are up, but they're going to come back down the trend. All right, going to come back to where you were. It's a word I don't think any of us use outside of studying for the SAT. I don't even know if you have SATs anymore, but that's a word we studied for. But now the other side of the thing is Team Trouble. You got Larry Summers up there on the upper right. Larry's asleep. Someone should wake Larry up. Apparently he's not as excited about inflation as he makes it sound. And then you've got Will Dudley, used to be in charge of the New York Fed. Those are, just to be honest, I got them on the right on this screen. They actually lean left. So think about that. You got some left-leaning economists who are being very vocal with the idea that all the stimulus that's out there, with the Fed keeping rates low, that's going to cause more inflation than anybody wants to see, and it's going to cause trouble, all right, down the road. So they lean left. They're not trying to get on, President Biden's cabinet, all right? If they were, they probably wouldn't be drumming up the trouble that they're doing. Trouble's a strong word, but drumming up what they're doing. So there's a lot of smart people that I want to get at on this side and that side. LPL continues to be on the side transitory. I remember 2010, 11, 12, how many times we heard all the stimulus we're doing, Zimbabwe-like inflations and Zimbabwe-like crash of their currency could happen to the dollar. None of that stuff happened. Well, why is that? Well, here's my cell phone, all right, here. I could order a hot tub and have it delivered in a couple of weeks. Well, who knows? You can't get hot tubs anymore. But what I meant to say is I can order just about anything on my phone, right? That is an amazing, amazing deflationary aspect that we didn't used to have. Globalization, machinery, technology, the Amazon effect that we have. All of those things are putting a lid on inflation in our view over the past decade. Yes, inflation's higher right now. We went 10 years, guys, with 2% inflation. We might see 2.5%, 3% inflation for a couple of years here. We're not calling that runaway inflation. And after the worst recession we've all lived through in our lifetime, in all likelihood, a little bit more higher prices isn't a bad thing. And let's be also honest, what are going on with wages? Wages are going up. So if inflation is going up and wages aren't, that's not good. Nobody wants that. But if wages are going up and keeping up with inflation like we're starting to see here, I mean, this is one of the first times, at least in my lifetime, where I think the workers have the power. Right. I mean, there are a lot of places hiring. Workers have a lot of opportunity. We've lost a couple of people on our research team because there's you can work from home and get interviews, and somebody's going to pay you 15% more, 20% more. This is an interesting world we're living in, with wages also going higher. So we're not as concerned about as inflation as some other places. So let's talk about policy. I'm doing time wise. I can just talk on this stuff. So I need to make sure I hit my marks here. Policy, taking a back seat. So what's policy? The Fed and the government, right? They pull different levers to get things going. One of the biggest reasons we upgraded our view in equities, March 2020, I think March 26th is the day we did it, was because the Fed on March 23rd came out and backstopped everything. And we said, okay, well, that, market sold off. We saw some internal things we wanted to see. Once the Fed gave a backstop and then all the fiscal policies coming from the government, those were tailwinds. Now we say taking a back seat. They still matter. Probably don't matter quite as much now, though. What's going to matter going forward is, corporate America taking the baton, earnings coming in, confidence coming back. What the policy is always important, but maybe not as important as it was a year ago. Now, taxes are coming. Sometimes gets people worked up a little bit, but it's factual. Joe Biden ran on higher taxes. We've got a lot of spending going on. We're probably going to have higher taxes. You can see here as a percent of GDP, we might see one of the largest jumps in taxes that we've ever seen. Now, also taxes are historically low. I mean, they're historically low. Burt White said about a year ago, these levels of taxes globally could be one of the lowest we're ever going to see in our lifetime. And taxes will start to work their way up. You kind of have to finance all the spending that's out there. It's kind of one of those, it is what it is. But the question is, okay, if we have higher taxes, nobody truly wants higher taxes, I don't want to think, but it has to happen to a degree to finance some of the things. Is it bad? Are higher taxes bad for your investments? That's the question. We've been asked that a lot over the past year. Obviously, when President Biden was running and everyone, if he runs on higher taxes, more regulation, is that a bad thing or a good thing? Here's the answer. Kind of depends. Isn't that a great answer? That's my TV answer right there. Because if you look at it, this is previous times that capital gains increases. Guys, in 69 and 76, what happened 6 months later to 12 months later? Stocks didn't do good. What about in 86 and 2013? 6 months later to a year later, stocks did pretty darn good. The truth is, again, in the 70s, it wasn't a good time for investments because the economy wasn't doing good. You had massive inflation. 86, you had an early economic cycle of growth. You had continued strong gains for a long time. 2013, relatively early cycle of growth with an accommodative Fed. Does that sound familiar? So again, we're not minimizing higher capital gains taxes. I read an amazing stat. Apparently this year, very well likely, will be the first year since the early 50s that corporate taxes increased and capital gains taxes increased during the same year. But again, is that a surprise? Right? We kind of knew this was coming if President Biden won, all right? And the stock market's been rallying ever since he won. Now, it's not as simple as he won. There's other factors in there, I'm fully aware. But again, it's like, okay, this is probably priced in. So no one, people get upset and talk about it. But again, a lot of it is priced in our opinion. And again, that's what we saw in history before. Jerome Powell's in charge of the Fed. The Fed is a hot button as well. Why does the president pick who's in charge of the Fed, right? Why is the Fed not audited? Why does the Fed have all this power? I can't disagree with any of that stuff. What I do know as a steward of assets, though, when the Fed is keeping rates low, expanding its balance sheet, meaning the Fed is buying bonds, and that's what you see. That's the Fed balance sheet. It's up to almost $8 trillion. Incredible. That tends to be a tailwind for risk assets. And again, not saying we like it, not saying we hate them, love them. I'm just saying if the Fed is doing what it's doing, along with all the other stuff that's going on, that's a tailwind that likely says risk assets, specifically stocks, will probably continue to do pretty well. It's not me who can't keep a secret. It's the people I tell who can't. Honest Abe. I love that picture of Abe with his cool new glasses there. So what's the secret? Fiscal policies in play also, right? We had monetary policy before in the financial crisis, but what's a little different this time? We've got massive fiscal policy. We've had $5 trillion of fiscal policy in CARES Act and all the other things. You guys have heard the news lately. There's another trillion coming in infrastructure, $3.5 trillion. All that's going to get cut down probably for the human infrastructure. So there's a lot more coming. This is now versus then. We spent spent the right word? I guess it's spent. We spent $800 billion of fiscal stimulus during the financial crisis. We're up to $5 trillion right now. It's like 6 times more. And there's more coming. All right. So again, this is a tailwind. We can complain about it and say, the government's printing money, the government's doing all this and that. Can't say I disagree with some of it. I don't like all of it either. But again, it is still bullish for your investments and something you don't want to bet against. So this shows now versus then as a percent of GDP. It's just, again, the percent of your economy. A lot of fiscal stimulus is taking place. Now, speaking of truth, secrets, and lies, I saw this quote the other day. I thought it was funny. Hopefully there's some Seinfeld fans out there. Remember what George told us? It's not a lie if you believe it. That's an oldie buddy goodie. All right, let's talk about stocks, bonds, and then do some Q&A. Gaining ground, and isn't that the truth? I mean, since we put that together a few months ago, you can maybe use a different thing, but stocks have absolutely gained ground, literally at all-time highs as we speak today. The debt outnumber the living 14-1. Ignore such accumulated experience at your peril. Neil Ferguson, historian. So 14 times the people that have passed away than lived. So I think it makes sense to pay attention to what we've seen in the past. I love the Churchill quote, the further into the past I look, the further into the future I can see. The gist of how I view the world. I like to see what happened before just to get a potential path, if you will, for where we're going. Guys, we're in the midst of an incredible win streak for the S&P 500. The S&P 500 is up 6 months in a row. What does history tell us that could mean? I know this stuff's guarantees. I mean, we don't live in guarantees. We live in coulds and maybes and shoulds, and you do enough of those, you kind of add them all up. It tells you, this is probably what might happen here. The truth is, after 6-month win streaks, a year later, after the 6-month win streak, stocks are up 18 out of 21 times. Up, Up almost 12% on average. The average year is up like 8.5%. So stronger than average returns and higher more likely than not. That's just one data point, fully aware. But lots of other data points, hopefully I'm pointing out to you today that do suggest, again, if I get to come back and hang out with you guys, in 6 months or a year from now, do it again, stocks are probably still going to be pretty good deal higher. And this is just one way to show that. So here's our forecast. Full disclosure, we're up in this because things continue to be really good. So you see earnings up to 195 and S&P fair value 4,400 to 4,450. That's like where we are right now. Earnings, if you guys can keep a secret, we're going to up this probably on Monday. We're going to upgrade our earnings forecast to 205 and likely take that S&P 500 target. I don't think we're quite there yet, but maybe to 4,700 or so. Because again, the big picture view, we're bullish. I'm a strategist that hates targets. People say, oh, is LPL bearish now because that's your fair value target? No. We still think stocks can outperform bonds. We still like this upward bull market. But the truth is, things have come back faster than we thought. We were one of the more bullish shops out there, all right, the year ago right now, for sure, even coming into this year. And it's been even better than we thought. And this earnings season, which I'll talk about soon, is justifying. It's incredible how corporate America's come back so fast, and us, the consumers, coming back so fast in things. I'm going to Dominican Republic in October, for our 15-year anniversary. And it felt really good when I booked that, I think in February or so, just to, book things like that and they look forward to getting out there and doing things again. And a lot of people are doing that same thing with earnings being so strong. So that just put that out there that yes, our fair value target is there, but internally and externally, when I talk, we still think this is a bull market. We are going to upgrade our view on equities here, or our fair value target, I should say, I believe on Monday. So don't judge a book by its cover. Anyone want to take a guess who this guy could be? Yeah. 9-time Super Bowl participant, 6-time Super Bowl winner, Tom Brady. The 199th pick in the draft. Everyone says Belichick's some genius. And I mean, yeah, he's smart. If he was that smart, he wouldn't have picked the guy 199. He would have picked him in his first pick that year, But still, hey, luck. I'd rather be lucky than good, I've always said too. So luck doesn't hurt, but hit the lotto, obviously, picking him at 199. But you look at that guy and you say to yourself, I'll take him 199. Maybe not one overall, because he's probably not going to play in 9 Super Bowls. Proved everybody wrong. By the way, did you see Peyton Manning's Hall of Fame speech? If you haven't, you got to Google it and watch it. It's hilarious. Peyton Manning's amazing. He's a great quarterback, clearly, but he's just hilarious. And he makes some, Tom Brady jokes and stuff. Anyway, don't do it now. Do it when I'm done talking. But check out Peyton Manning's 7 or 8 minute Hall of Fame speech. Tom Brady's there. It's hilarious. Anyway, so don't judge a book by its cover, which leads us to year 2. Everyone year 2 of a bull market. Everyone thinks year 1's up a ton. Year 2's got to be bearish. Don't judge a book by its cover, guys. Every single year 2 of a bull market since 1950 at least, stocks were higher. That's what I'm showing right now. The average first year gain, 42%. The second year gain, stocks usually aren't up as much as the first year. That's how it works in a bull market. That second year is up almost 13% on average, never been lower. So just a key concept. And then second year of the bull market started back in March, right? Because March 2020, March 2021, second year of the bull market. We've had some pretty solid gains since then, I'll be honest. But still, this is stuff we've been talking about for a while at LPL Research. That, second year of bull market, it can be choppy. It can be frustrating. We had a 16% correction in 2010, second year bull market. 2004, stocks kind of went second half of 2003 and most of 2004, stocks were sideways, kind of choppy. 84, 83, 84, after the 82 low, stocks were kind of choppy. So year 2 can be frustrating. That's perfectly normal. That's what history tells us. But they also tend to be higher. And once you get to year 3 and 4 of the bull market, that's when those gains start accelerating again. So none of this stuff is perfect. It doesn't always work out the way you want it to. But that's what we know about history. So just be very aware of that. We'll kind of skip that one. So stocks aren't cheap anymore. All right, we'll admit that. I mean, coming into this year, a lot of people were worried about, I don't want to get too geeky, but you maybe heard of PE multiples, price to earnings multiples, what you're paying versus what they make. If something isn't making a lot of money, but you pay up for it, that means you're paying a premium for it. That doesn't mean it's bad. It can still go up. I mean, Warren Buffett has said many times he should have invested in Amazon, right? But it didn't fit kind of some of their criteria they were looking for because it was always expensive. Yet its earnings were growing exponentially, even though it was pricey. So sometimes things are pricey for a reason, is what I want to say. And coming into this year, when we were bullish on stocks, a lot of people said, stocks are expensive. We didn't disagree, but guys, stocks are up like 18% for the year. You know what earnings are up? Like almost 30% now. All right. So stocks are actually cheaper now than they were at the start of the year. Isn't that kind of crazy? After these big gains, his earnings are growing faster than stocks. So stocks are actually a little bit cheaper than at the start of the year. No doubt about it, though. A worry. I got a few more worries, coming up, I believe. But one of the worries is stocks aren't cheap. Also, I don't think I have it here. Well, the other worry is potentially August and September, 2 of the worst months of the year. All right, tomorrow's Friday the 13th. Don't worry about that. But historically, from the calendar point of view, after a big rally, you could have some seasonality, a well-deserved pullback. So just some things to be very aware of. We'll try and wrap this up in 5 minutes, and we'll do Q&A. Change is inevitable. Change happens, whether we like it, whether we don't. Things are going to change. This is 1899. The U.S. was 15% of the global stock market. The UK, 24% of the global stock market, 1899. Check it out today. US, huge, obviously. Where's the UK? I don't know where they are. 4%. All right. So things change. Do you think the United States is going to have more or less in 100 years from now? I mean, who knows? I think we probably have a little bit less. There's some other areas there. But the truth is, change is inevitable. We have to be aware of that, and we have to plan accordingly. But here's one thing that hasn't changed and will likely always be important. Earnings. Earnings drive long-term stock gains. Guys, you can see here, this is something we call our earnings season dashboard at LPL. Our EPS growth in the upper right, 85%. It's actually close to like 90 now, right? That's year over year. Just a couple of weeks ago, it was expected to be up 65%. Now we're pushing 90. Almost 90% of companies beat on revenue and earnings. This is like quarters and quarters after the COVID, the COVID crash took place. It's just amazing at how quickly earnings are coming back. And it's one of those reasons, again, why we feel comfortable upgrading our fair value target on equities again, because earnings are justifying kind of where we are. We'll skip that one. So maybe I'll just talk just for a minute, because I know we're pushing on time. What are we going to do? Well, let's say we get a correction. Let's say we get the normal 8% correction over the next quarter, which would be perfectly fine after a 99% rally. We still like value, all right? Cyclical value, industrials, financials, materials. Look at copper, look at industrial metals, tin, zinc, nickel, all that stuff. Really strong, since the global economy is likely strong. So those are kind of the areas that we're optimistic on. We don't have a problem with technology. We're just more even weight technology. I think early in economic cycles, small caps do a little bit better than large caps, and some of those cyclical value could offer some opportunity. Is kind of how we see the world. So let's talk about bonds and then wrap it up. Safety features. Bonds help you stay in your stocks, is how I put it. There's always a place for bonds in a portfolio. If I talked to you guys a year ago, 6 months ago, we said, listen, stocks will probably beat bonds, right? Stocks are up like 35% the past year. Bonds are up a couple percent. All right, year to date, bonds are like flat. Stocks are up 18%. So we still, fortunately, the way we construct our portfolios and models for our LPL advisors and their clients, we've been doing pretty good because of the way we've seen things. And we still think stocks will probably do a little bit better than bonds here. But bonds help you sleep at night. When you have a March 2020 and that big sell-off, you've got a little bond exposure, a little cash, a little gold, whatever it is. Sometimes those things help you sleep at night to stay in your stocks, and that's kind of the job that they bring to the table. So this is a kind of geeky thing, but hopefully it makes sense as I explain it. We've got the copper to gold ratio. Very simple. That's the teal color one. If copper is doing better than gold, industrial metals are outperforming precious metals. What's that tell us? Well, probably the global economy is good, right? Precious metals probably wouldn't do as well if the economy wasn't doing well versus if it is. So copper breaking out to like almost all-time highs or close to it here, that's a really bullish signal for the 10-year yield. That's the other, the darker blue there. 10-year yield, remember, if yields go up, bond prices go down. And that's usually how that works. What they taught us in Finance 101 many years ago. We saw a big surge in the 10-year yield in the first quarter. Bonds had one of their worst first quarters ever. Bonds had a rough year. Our base case at LPL Research is this. The 10-year yield will probably continue to go higher. We think about 175 or so when all is said and done. And if that were to take place for the 10-year, I think the 10-year is about 130, 135 right now. Honestly, didn't look today. Still more appreciation as the economy gets better, a little more inflation expectations. That could impact bonds a little bit, but could still help stocks. You know who a higher yield tends to help? Financials and banks, because banks make a little bit more money there if yields go higher. So it's another reason we think value could do well. Just a couple more, then we'll do Q&A. Diversification is the only rational deployment of our ignorance. Peter Bernstein, that sounds just like Peter, read a lot of his books. He's saying, stay diversified. It'll help you stay where you're supposed to be to reach your long-term goals. And again, work with board, work with your advisor, exactly how to position your portfolios. But to stay diversified, helps you stay in the game and reach your long-term goals. So yes, we don't like bonds as much as stocks, but we still think bonds make sense. We're overweight stocks relative to bonds in our models, yes. But still, there's always a place for bonds. If yields keep going higher, with things like mortgage-backed securities and bank loans and getting geeky on you, shorter duration bonds, high quality, those can still do pretty well. Okay, it doesn't mean they have to do terrible, but again, there's still some opportunity there to stay diversified. That's the last chart about the market, and then we're going to move on. What happens when the stock market goes down? Well, bonds usually do pretty good. This is why you need some bond exposure still. What we're showing here on the downside, that's the S&P, some of the worst months ever, or at least in recent memory since 2000, versus what the top part is the Barclays Ag. That's your average bond fund. Well, not surprisingly, when stocks go down a lot in a month, bonds more often than not go higher for the month. And again, that's helping you stay diversified, helping you sleep at night, reach your long-term investment goals, maybe with a little less volatility. Those meme stocks and all the crazy stuff that's going on, those stocks go up here and they go down. And it's tough to stomach it, right? And we're not at all advocating to be in them, but I'm saying if you have a diversified portfolio with some bond exposure and a little bit of cash maybe or something like that, with a good amount of stocks, you can still get to your long-term goals and maybe not lose a ton of sleep. March 2020, we all lost sleep, but for the most part, we get a 10% correction sometime this year, which we don't think we quite get 10%, maybe 8% could happen. A little bond exposure is going to make that feel a lot better. Finish line, open roads ahead, guys. There's a long way to go, but I'm honored you had me back. Hopefully in 6 months we get to talk again and things are still doing good. Leave on a positive note, similar to the 7-year itch I showed earlier. This is new highs. New highs happen in clusters that last a decade or more. All right, we've been making new highs in the S&P since 2013. Just look at history. All right, we could see new highs for many, many, many more years if you look at how clusters work in the past. So just kind of be aware of that when we get the scary days and the pullbacks. And the guys like me are on CNBC talking about what's going on. There's still a lot of opportunity. And this is the last one. Don't forget how lucky we are. Harvard did a study that the odds of being born are 1 in 400 trillion. With a T, that's like mom meets dad, grandma, grandpa, wars, famine, all the horrible things that have happened for thousands of years. The fact that we're born and sitting here is 400 trillion to 1. Oh, then let's throw in the fact we're in the richest, safest, I think, best country in the history of the world. That's hitting lottos among lottos, right? I mean, so we're really lucky. The odds of 1 in 400 trillion are this. You know, those circular lifesavers you see on the side of a boat when someone drowns, you throw out there and save them. You take one of those lifesavers, throw it in the water. You take one dolphin and let that little guy swim into the 7 oceans, and you tell that dolphin to pop his head up. If he pops through the lifesaver, that is approximately 1 in 400 trillion. Those are the odds that we are even born. All right. So believe me, I got a 13-year-old daughter. We talked about her. So the other day she goes, "Daddy, you're looking gray." I'm like, Jesus, like you try to manage billions of dollars people in the midst of a pandemic, you're going to get gray too. I didn't say that to her, but we've all got good things and bad things that happen to us. But sometimes let's just remember how lucky we really are to even be born. And then we're in this beautiful, awesome country with the fact of a good bull market and hopefully some continued gains on those statements that you get sent from board and the crew. A couple different slides on disclosures just because the lawyers like that. All right, guys. How did I do time-wise? I'm sure I went too long, but hopefully that was good, and hopefully we've got some great Q&A. Let's do it.
Fantastic, Ryan. Thanks so much for your presentation. I just want to double-check with Michelle. Do we need to throw those disclosure slides back up there a little longer?
Yeah, we can throw those up for a little bit longer.
There you go.
And that'd be great. Thank you.
Yeah,
and as a reminder, any questions can come in to Michelle. That's Michelle with 2 L's. Michelle at covenantwealthstrategies.com. So we did have a question, Ryan, that came in. Actually, a number of people on our Covenant Wealth Strategies Investment Committee sent me a question, and they all came in right about the same time. They wanted to clarify. They think that there was an invitation extended by Ryan Detrick for our Covenant Wealth Strategies Investment Committee to come discuss inflationary concerns in your hot tub. Is that so? We wanted to clarify. Was that correct? Did we understand that?
Yeah, I mean, you know what? It's a 6-person hot tub. That's not to say we couldn't cram 7 or 8 in there. So that's inflationary by itself. So yeah, let's do it. I love it. Hot tub's 99 degrees right now. I'll probably get in later this evening. So let's do it. Yeah.
Well, that might cause the water level to go up, which could somehow be inflationary, I guess, on the water level.
That's right.
Speaking of inflation, question comes in, how do you define transitory? Specifically, the Fed is referring to inflation as transitory. You did put this slide up there with the people on the left and the people on the right. So how do you or LPL's research department agree or disagree with the Fed's expectation that inflation is transitory once you've helped us to define transitory?
Sure. Before I go there, I will say, so my wife and 2 sons are in Atlanta. As we speak, the Reds are playing. We're from Cincinnati. They're huge Reds fans. It's not 5:10 yet. The game starts at 5:10. Long story short, my wife's in Atlanta. So if you guys want to have some fun, come on down tonight. We can do whatever we want tonight in the hot tub. So that's what I'm getting at. But anyway, my wife would let us do whatever we want anyway. But anyway, so with transitory, that's interesting because the market and the media, everyone said, okay, transitory, likely means in a couple of months, we're going to come right back to trend. Literally a month ago, and I'm guessing this is where that question came from, Jerome Powell was explaining his definition of transitory, and he was saying transitory actually kind of means you're going to keep kind of going up, but just not go up as fast. All right, so almost a little different than kind of what he implied maybe, let's say 6 months ago or 4 months ago. But we're in the camp that transitory, again, likely means we're going to come back to trend. So let's say what was the recent data? I think 5.4. I think 5.4% year over year was the inflation data that we just saw. We think at the end of this year, we'll be back sub 2, maybe more like 2.5%, which is a tad more than the 2% we had for a decade. But again, likely coming back to trend. That's kind of how we see it. I guess it's almost as simple as, it's kind of one of those, when you see it type of deals. We just don't see a 1970s massive stagflation environment, which I guess shameless plug, go to lplresearch.com right now or later. We wrote today about stagflation because we're starting to hear that question. We talk about some of these concepts. We just simply don't see a 1970 style inflation scare that would last for several years. Again, we're saying by end of this year, inflation likely is back with about 2.5%, maybe a tad higher, which again is closer to trend than the 5.4 we just saw yesterday with that CPI number.
So, question that's different but might segue nicely is, do we have a sense as to timing as to when we will see some of the supply chain issues start to work themselves out? And Ryan, you might want to kind of take the segue that talking about how supply chain issues, you referred to it with your hot tub cover, but how supply chain issues are a significant part of the inflationary problem right now.
Yeah, I mean, they're exactly right. I mean, that's the issue. Materials aren't being made, or they are being made, but not being gobbled up fast enough. The supply chain. I mean, we've had ships stuck in the Suez Canal. If you read about some of these ports, it's calmed down a little bit, but like the ports in LA and different ports, they've been more crowded than they've ever been. Ships are just like sitting there for like weeks on end with the parts. Maybe the hot tub covers are just sitting there, come in wherever they come in from. Well, actually, my hot tub cover comes from Oregon, but still. That's the issue that we have with these incredible, log jams, I guess we'll say. But the truth again is we think those are going to start to work the way out, right? Within the next quarter or so. So let's call it October, November or so. We think a lot of these supply chain issues are going to work their way through. I mean, the truth again, the economy's coming back so much faster than anybody thought. When you put the brakes on and then it just comes soaring back, that's kind of playing in. The recent GDP number. That's the economy thing I was talking about. The recent GDP number came in 2 weeks ago, maybe, and it was strong, yes, but it said, we had a drag on inventory more than anybody thought. Why is that? Well, because the inventory is just sitting there, right? I mean, they're having some issues with things. They're having issues shipping and different things and get it out there. The good news when GDP is a drag, inventory is a drag on GDP, that means a quarter or two later, it's going to be a plus because it's going to be getting out there, getting to people. So, we've hit these log jams, but we really think before this year is over, inflation comes back and a lot of these, hopefully I've got my hot tub cover. I say just give me a hot tub cover by the time the Super Bowl takes place, I've got literally like a tarp over my hot tub cover. It looks kind of interesting, but it works. But still, we think, within the quarter or so, a lot of these issues will be worked through the system in all likelihood.
So you mentioned financials as a sector because rising interest rates do well. You mentioned industrial metals in terms of commodities. What about transports, such as, for example, railroads and trucking companies? Because it would seem as though if there's such a massive bottleneck of materials, part of that is going to be transportation. It would seem the transports could raise their prices pretty easily because people are willing to pay to get their hot tub covers.
Yeah, exactly. No, transports and small caps are two also kind of we'll call more niche areas, I guess we'll say, that we do think have a lot of potential for the reason you're saying. If you look back in history at what groups do the best, we'll call it the first year and a half, 2 years of a new economic cycle of growth or a bull market, it is the more cyclical areas like your small caps. Small caps historically do better than large caps, but transports also do a lot better than, say, like consumer discretionary or something a little more defensive. So those areas are definitely likely to continue to lead. And another kind of 2.0 to this, the idea of like casinos and airlines and some of those areas, call it the scene of the crime, if you will. What we've seen historically, guys, with the scene of the crime, those groups usually don't do as well. Tech bubble. Tech crashed, right? Amazon was down 98%. It took a long time before it became Amazon again after that. There were issues. Financial crisis. Financials crashed. Financials have really struggled for a long time. They should take leadership now. But the scene of the crime, the two previous times, those groups and areas didn't do as well. So it doesn't mean there's not opportunity there. But again, some of those areas that really got beat up on the way down recently, those the next 3, 4, 5 years might not quite do as well as you might think. They don't bounce back as fast as we've seen in history. But small caps and transports are two areas that absolutely early in a cycle of growth makes sense. They can, I guess, going to get geeky on you. You have some alpha, meaning simply outperformance versus the market. We think there's some alpha in transport and small caps.
Wonderful. We have a couple of more questions that have come in, Ryan, but I want to be sensitive to your time because we are at the top of the hour. And I understand that you need to pick up your daughter from cheerleading, and so we want to make sure that you're not late. Otherwise, we might find you on that cheerleading team yet, right?
Mom would be mad at me. But I honestly, if you want to give me 2 questions, I'll try my very best to give 2 quick answers. I don't have to get her for 30 minutes. If you want to give me 2 quick answers,
okay.
I can give a quick answer.
Okay. So
that's the hardest thing for me to give a quick answer. Let's see if I can do it.
Another question we have, how will the additional COVID unemployment benefits, which are scheduled to run out or expire in September, impact the economy and the market moving forward?
Yeah, I'll try to do the quick answer. We think positively. I just went to lunch with my daughter today, right? The service wasn't that great. They said they don't have work. It is what it is. You're seeing this globally where people don't necessarily want to work. But with those going down, the benefits going away is what I should say. The more people get out there, and we just saw, almost 950 million jobs created last month. We're still almost 5.6 million jobs away from pre-COVID levels. So there's still a lot of people that need to get back in the workforce. And one could say that's actually a good thing because the economy's doing good. Now, a lot of people, once the benefits kind of go away, they have to get back in the workforce. And that could be a positive to keep driving this cycle further and better. Mm-hmm.
Wonderful. Well, Ryan, we thank you so much for your time this afternoon. It is always informative, educational, entertaining. So my last question that I have for you is your top 2 or 3 ideas. We talked about a lot. I might ask the question, you seem very optimistic, you seem very bullish. What would it take for you to become not bullish? What would it take for you to have a negative outlook on the economy and the markets going forward? So I could ask that question. I could also ask the question, what are your top 2 or 3 best ideas for the next 6 to 12 months?
Mm-hmm. Yeah, best ideas, I kind of hinted at them. Financials went nowhere for 4 months, okay? Just yesterday and today, they broke out, all right? So they've consolidated for a while. Some of those large caps in those areas that have done well, your tech names everyone knows and loves, they're showing some potential weakening signs. So we think, again, those financials, those banks can do really, really well. That might be one of our favorite areas right now. Also, biotech, I got to get too in the weeds on this, but you look at biotech, all the amazing things that have been taking place. Biotech would be one specific little area where maybe you can find the right part of a portfolio. We're looking at the right way. There can still be a lot of opportunity there. And
biotech has really struggled year to date in terms of, I think, even though the market's up, biotech has been negative year to date.
Yeah, and if you look under the surface of different biotech indices, and that's exactly right, but it had a huge move last year. It's almost like small caps, right? Small caps in the fourth quarter were 25%, the largest move they ever had. Most of this year, they've gone sideways. Biotech's a little bit like that, where it's just consolidating. You asked me the question, the next 6 to 12 months. I don't want to buy the thing that's up the most the last 6 to 12 months. I want something that's consolidating that could break out and do a little bit better. So small caps are one area like that, but biotech's another that's kind of just biding its time with a lot of earnings growth and some potential for more investment to come in. We like that. Now, what worries us, what keeps us up at night? Well, a Fed policy mistake. I said myself, we don't see inflation being a problem. What if it is, right? What if inflation is not transitory and continues to go higher like a lot of smart people think? Then the Fed has to hike rates a little bit more and choke off potential growth. That's not our base case, as I laid out, but that's absolutely one. And the other wild card that's just taking place is China. U.S. and China, it is what it is. U.S. and China relations are about as salty, I guess you could say, as they've ever been. You see what China's been doing lately, guys? They've been bombing their own, might be the wrong word to use. They've been going after their own companies, okay? They've been hammering their own companies. They've been hitting their own stock market. What if China gets bored of hitting their own companies and said, you know what, let's go after some multinationals next. Let's go after the U.S. companies next. That could be a big issue. And what's the tick and the tack and the back and the forth the U.S. does if China starts to do that? So that's another one that is out there that I do worry about.
Great. Well, Ryan, we'll look forward to having you back in about 5 or 6 months, and we'll take a look and see how well your forecast did and your slides, and hopefully we can get you back in a December, January timeframe and do a reflection on the last 6 to 12 months and predictions and forecasts for the year ahead. We always enjoy, we get great feedback, great comments come in. Thank you so much for sharing your talents and your time with us and our clients and guests here at Covenant Wealth Strategies.
Well, I'll end with this. Thank you. You asked me, I'll be there. Don't worry about that. I'm a huge fan of what you guys are doing, but everyone on this line, you guys are so lucky because I get to talk with a lot of advisors, right? And some of them don't reach out to Ryan or the team and ask for other opinions, ask for help, but not help. I'm the wrong way to put it. But you guys are just in really good hands. Market's going to pull back. It's going to be scary, but Ward and the team are going to show you the right way to go, and they're there for you. Nobody has truly all the answers. No one pretends to have all the answers, but just being there for you, doing these webinars, doing these things, you guys are in awesome hands. If there's anything I can ever do, Ward, I'm a text, email, phone call, whatever. No one uses the phone anymore. But anyway, I'm there for you if you need it, but just you guys are lucky to be in really good hands. I just want to really stress that.
Ryan, thanks for your kind comments. God bless you and your family, and we'll talk to you again soon.
See you guys. Thanks. Bye-bye.